Hey guys, you're tuning in to howtoplaystock.com. My name is Kepley. Today's January 30th, 2017. And in today's video, I'm going to cover the topic of wealth cycles. Now, wealth cycles revolve around business cycles, which on average last about 8 to 10 years. Okay, and so what I'm going to do in this video is I'm going to go in and I'm going to show you just how the business or wealth cycle works. And then I'm going to explain to you a strategy that has been used by a British stock investor by the name of John Templeton. I'm going to explain his strategy for investing because it revolves around wealth cycles or business cycles, and it is one of the ways that a lot of the top 1% of wealthy investors have continued to become wealthy over time. And this utilizes insurance, which would be hedging or protecting your wealth when markets are contracting and getting ready to head into either a recession or a stock market crash. So the information I'm going to show you in here is really beneficial, so pay attention, and I'll see you in the next portion of this video. Okay, so we're here looking at the business cycle chart, and I'm just going to explain kind of what the business cycle is about, and what it includes as far as data that you're looking at. So this is a typical business cycle. Now these business cycles last 8 years on average. Sometimes they'll go a little bit longer, but as you can see here, early in the business cycle, activity rebounds, and that affects your GDP, incomes, etc. Credit begins to grow, profits grow rapidly. Policy will still stimulate, and then inventories are rather low, so your sales improve, which equals economic growth. So this is what you get in the beginning of a new business cycle. Is the recovery process, and then it goes into an expansion, which is mid-level here. Growth starts peaking, credit growth is strong, you get profit, growth peaks, things of that nature. So I'm just reading off of what's up here in the top portion if you're looking at my cursor. So that's midway through a business cycle, and then late in the business cycle, your expansion starts to contract. It starts, instead of expanding, it's still expanding, but instead of expanding at a strong rate, it starts to slow, as you can see here, and you start sloping off, and you go into contraction. So late in the business cycle, you get growth moderating, credit tightens, earnings start becoming under pressure. And if you look at where we're at right now, in today's January 30th, 2017, if you look at where we are right now in the business cycle, right now we're pretty much late in the business cycle because earnings are under pressure, as you can see in the stock markets. You had the Dow Jones that just hit over 20,000, so we were at an all-time high. It's fluctuating a little bit, so it contracts and then it shoots back up. So we're late in the business cycle right now. Credit's tightening. You got the Fed out there talking about raising interest rates, and they're wanting inflation. So you're getting a lot of stuff that's starting to take place, and you're seeing it in the news with policy. And look, as you can see right here where my cursor is, it says policy contractionary, policy contractionary. And as you can see in markets right now, monetary policy, it's been contracting for a while, and they've had interest rates at dang near zero for almost an entire decade. This has, if you're looking at a business cycle, this has been the third largest expansion in stock market history. So we're coming to an end here. We're late in the business cycle, like I was talking about, And what's to follow is contraction, and that's when you start getting stock market crashes and we go into a recession like we did back in 2008. So that's what's coming. If you look at my cursor right now on this chart, I'd say we're probably right around in here at the moment. And from 2017 going into 2018, we're going to go into this contraction. And if you look at major index charts, like retail, for instance, or the Baltic Index, which measures trade, international trade, um, you can see that the contraction is already starting to happen. People are starting to do massive layoffs and stuff of that nature. So that's the business cycle chart. Now I'm going to take you back to finish out the rest of this video, and I'm going to show you basically how the 1% or the wealthy or the smart money invests off of business cycles. I'm going to show you how they do that and how they create their wealth and basically rinse and repeat their whole strategy through a business cycle.
Alright, now that you know what the business cycle is and how that's broken down into the different categories of recovery, expansion, contraction, and stuff like that, what I'm going to show you here is the investing plan that John Templeton used. And there's a lot of other wealthy investors who kind of use this strategy as well, and it helps them build their wealth tremendously over time. Now, if you have long-term investments going, and you're somebody like me who's got a portfolio long-term, hold on to that, okay? Because especially if you're in your mid-30s or maybe even late 20s, even early 20s, if you're somebody who has time on their hands, then you can basically endure the losses that you might face in a stock market crash. Okay, so if you're in long-term investments right now and you got a long-term portfolio going, stay in it. And the reason why is because you can take advantage of compounding and dollar cost averaging as the markets contract and we go into a recession at the end of a business cycle. Alright, this allows you to basically use your dividends and buy up broad parts of the market for pennies on the dollar. Alright, but what I'm going to show you here is kind of how this works. So you got a chart like this, and this is just an example of what broad markets will do over time in a business cycle. So you got 8 to 10 years, they'll go up to a peak here, and then they'll come back down. Alright, now what you want to do, if you've got long-term investments going, stay in them. Now if you're older, you'll probably want to think about maybe getting out of some of your long-term investments because you can't afford to lose that wealth. But what you can do is utilize your insurance or start hedging some of your wealth that you've already built up, and you can utilize it and make profits when we're coming into the downside here, when we start experiencing the market crashes. Now, how the wealthy do this and how John Templeton did it, basically, if you know who he is, you can go out and research him. But what he did was back in the Great Depression, when the stock market crashed, what he did is he took his money and he waited. He got out of his investments, or had like $1,000 or $10,000 saved up, and he just waited until the prices came down and we hit a low at the end of the business cycle, where when we went into the Great Depression, he just waited until the prices came back down to where they're supposed to be, and then he bought up the broad markets for pennies on the dollar, and then a new business cycle started. And so he just basically wrote up the business cycle, and he rinsed and repeated this process throughout time, through an entire wealth cycle of a country, and that lasted about 75 to 100 years. Normally, on average, that's what a wealth cycle will last for an entire country. And what you do is you take the wealth cycle and you break it down into business cycles. So that's how that's the correlation between business cycles and wealth cycles. But what you're doing here, if you got long-term investments set up already, stay in those, especially if you're younger. But what you want to do is take basically just repeat what he did. Take like $1,000 or $10,000. You want to get into some hard assets. And I'm going to show you a way that you can basically take your $1,000 or $10,000. You can invest it in hard assets during the downside of this. You can create money while it's crashing, and then get out and transfer that money over at the bottom. Okay, so what I'm talking about here is, let's say you're paying attention to the markets and the markets peak, right? So we'll use the Dow Jones for example. Right now it's at its all-time highs. It broke 20,000 last week, and so now it's starting to kind of contract a little bit. It might still stay up there for a little bit longer, but it's not going to last. And knowing this, what you could do is take, if you've got, say, $1,400 or $2,000, whatever it might be, you could take that money right now and put it into hard assets. Okay, get ready, because what happens when these markets start coming down, all the smart money is already going to be in these hard assets. So you want to go where the smart money is going, and the smart money always gets in before something actually happens. So that's part of the pre-planning to this whole strategy that John Templeton used, and a lot of the other wealthy investors use. Is they get ahead of the curve, they get ahead of the masses, and they invest in these hard assets and get out of paper assets. And when I say paper assets, I'm talking about like your long-term mutual fund investments that you normally would use to build wealth over time. Now it's completely up to you what you want to do. Do you want to sell out of your portfolio? That's fine if you want to do that. But if you've got time on your hands, you might as well just stay in and take advantage of the dollar cost averaging from your dividends, because that's going to help you tremendously as the markets are coming down. So that's why I say just stay in them. But if you want to sell out of them and you want to go into like a safe haven asset or hard assets like silver and gold, that's a great idea, especially right now. And I've shot several videos on this and explained why silver and gold are they're heading into some great years here through 2017 and 2018. And if you don't know what I'm talking about, just go back and watch one of my videos on silver and gold. I'll put a link in the description here of this video so you can go back and watch those so you know what I'm talking about. But getting back to the point here, what you're going to do is you're going to take your money that you have, you put it in something like silver. You could get into the physical silver, or you can get into the silver contracts, or gold for that matter. But you'd want to get in right now, because right now you're still kind of ahead of the curve. Okay, you're ahead of the masses. And if you know where the business cycle is and where we are right now, we're at a peak. We're going to be coming down the back end here. We're going to go into a recession here soon. I'm just basing this off of pure math. Okay, so it's going to happen here soon. When that happens, though, if you're in silver or gold, what normally will happen, those might go down in value short term, and I'm talking maybe like a few months when this thing starts really falling. They might go down with it, but they end up reversing, because all the money that's in 401k accounts and the masses out there who are invested in mutual funds, they start panicking and they start selling. Okay, and that money transfers over into silver and gold or safe haven assets. But they might be even getting into like real estate for that matter. But what that does, it drives the prices up on these assets. So as this market comes down like this, your assets, like your hard assets like silver and gold and real estate, they might come down a little bit with it, but then they're going to rebound and go up in value. And that's where you start making your profits. Well, as they go up, they're going to eventually get to a peak. Okay? So their charts that you're looking at for like SLV are going to be completely inverted to this chart right here starting out. And it's kind of hard to show you on this graph here without having two separate charts to look at. But the chart for silver right now, it looks like this. It's going to look like, it might look like something like that. instead of what we got here. But when the markets start dropping down, it completely reverses to the means, and it starts heading up as this market starts coming down. Does that make sense? And what you end up doing is you just wait for the bottom on the markets to hit, and when that bottom starts settling in and assets start coming down in price to like a fair value, then what you do is you sell on your assets up here, like silver and gold and real estate, if you've got real estate for that matter. You get out of those because you're making a lot of profits on those, so you have more dollars, you have more currency in your pocket now, and then you take that currency and you transfer it back over here and you buy in at the low. So you end up buying the entire markets for pennies on the dollar. You buy in at the very end of the contraction, or at the recession or depression or whatever it might be, at the end of the stock market crash. And basically what you've done is you've set yourself up for the new business cycle right down here at the bottom. And when the new business cycle starts, well, you just ride it all the way back up, okay, to the very top here, and you do the very same thing. You sell at the top, take your money, you transfer it over, you buy in on hard assets, let it skyrocket as the markets come down. You make your profits, you take your money, you take your profits, you transfer out, and you buy back in for pennies on the dollar, and you just repeat the process every 8 to 10 years. And you could probably do this for at least 75 to 100 years. Okay? That's how John Templeton made his money when he was investing. He's considered one of the greatest investors of all time. If you don't know who he is, again, go research him and find out a little bit more about him and how he did this. But that was his strategy plan, and there's a lot of other great investors who have used this same strategy throughout time to build their wealth. And that's one of the reasons why the wealthy keep getting wealthier, because they know the game they're playing. And you'll hear me talk in other videos. If you're subscribed to the channel, you'll hear me talk in other videos about this. Okay? You'll hear me talk about how you need to know the game you're playing, because if you don't, the game of money will be played against you. And that's exactly what I'm talking about. It revolves around business cycles and wealth cycles of countries. Okay? That's all I have for today's video. You're tuning in to howtoplaystock.com. If you have any questions or concerns, leave comments in the comments section. Also give me your thoughts on this, okay? Let me know if I'm doing a good job of covering this material. And if you have something in mind that you want to cover, you want me to cover, go ahead and let me know as well, and I'll shoot a video on it. But that's all I have for today. If you haven't subscribed to the channel, please do so, because I'm creating playlists throughout the year on investing. I'm covering different topics, going back and recovering topics that maybe I didn't do such a good job on from last year. And you can really increase your knowledge about the topic of investing and prepare yourself so that you can have a better idea of what it takes to build wealth over time in the stock markets. Okay? But that's all I have for today. Again, remember, income's the outcome, guys. All right? You have to be patient with this kind of stuff, because it does take time. Like I showed you here, the business cycle lasts about 8 to 10 years, so you're going to have to be patient with this. All right? But ultimately, the goal is income is the outcome. You want to outlive your income. And the only way to do that is to build wealth and get your money working for you. This is a great way to do it. Okay? That's all I have. I'll talk to you guys here soon.